Welcome to the deep dive. Really glad you could join us. Today, we're jumping right into something absolutely crucial, but maybe often overlooked for a lot of professionals, especially in tax and accounting. We're talking legal duties, responsibilities, the whole nine yards. You've shared some really great source material with us covering legal liabilities, professional privileges, and this thing called work papers. So, our mission today, let's unpack all of this, cut through the jargon, and pull out the really important stuff so you walk away feeling, truly informed, not buried under details.
Exactly. And it's not just about knowing the rules, right? It's about getting those subtle differences, the distinctions that, well, they can have massive real world impacts for the professionals themselves and for the people relying on them too. It's about what's really at stake.
Okay, let's get into it then. Our sources start by laying out two main foundations for legal actions against tax preparers. We've got traditional contract principles and traditional tort principles. Can you kind of break those down for us?
Absolutely. So when we talk about contract principles, think of it like a specific agreement, a promise. The preparer has an obligation based on that agreement to prepare the tax returns diligently and competently. It really boils down to a promise was made, and was that promise kept?
Okay, a direct promise. Makes sense. And tort principles.
Tort principles are, well, broader. It's more about a general professional standard. It's this duty professionals have to use the level of skill, care, and diligence that other members of the profession would typically use in similar situations. So it's not tied just to a specific clause in a contract. It's more about meeting that baseline of reasonable professional conduct, period.
Got it. So if someone thinks a professional didn't meet that standard or broke that promise, how do they actually prove malpractice? I know the sources listed four key things.
Yeah, that's right. To win a malpractice case against a tax preparer, the plaintiff, the person suing, has to prove four things. No ifs, ands, or buts.
Yeah.
One, the tax preparer actually owed a duty to the taxpayer. Two, there was a breach of that specific duty. Three, the plaintiff suffered actual injuries, usually financial harm. And four, that the breach of duty caused the injury. There has to be a direct link.
Okay, that causation part seems really key. It's not just they messed up, it's they messed up and that's why I lost money.
Precisely. No harm, no foul, legally speaking. A mistake without damage doesn't usually lead anywhere in court.
All right, let's dive into that first foundation you mentioned, breach of contract. Can we use that real world example from the sources? This feels like the most straightforward path sometimes.
It often is, yeah. A CPA can definitely be held liable if they just don't do what the engagement letter says they'll do. And the key idea here, legally, is privity. Think of privity like being part of the original deal.
Yeah.
A direct link. Generally, only the people directly involved in that contract, or maybe someone specifically named as benefiting from it, can sue if the contract is breached. It's usually a closed circle.
So like the example with Alan Sims and Joe Foster.
Exactly. Let's walk through that. Alan Sims hires Joe Foster, the CPA, right? Needs his federal return and 3 state returns done. They have a signed engagement letter. It clearly states the deadline, April 1st. Alan needs it by then for a family trip, makes that clear. He provides all his documents on time by March 10th. But Joe Foster's firm doesn't actually finish the returns until April 30th.
Ah, okay.
So did the CPA owe a duty?
Yeah.
Yeah, the duty was to meet that April 1st deadline specified in the contract. Did they breach it? Yes, they finished late. This could very well lead to a successful breach of contract claim because, well, the terms of the agreement just weren't fulfilled. Pretty clear cut, usually.
Okay, so contracts are about specific promises. But you said torts are broader, more about general professional standards. What were those 3 torts again that apply here?
Right. Beyond contracts, CPA liability can come from 3 main torts. There's negligence, then constructive fraud, which is also called gross negligence, and finally, actual fraud.
Let's start with negligence. What does that actually look like for a CPA? Is it just making a mistake?
It's a bit more than just any mistake. The general rule is a CPA owes their client a duty not to be negligent in their work. Negligence itself means there's a breach of the duty to exercise due care. And the standard for that care isn't perfection. It's about performing with the same skill and care that an ordinarily prudent, or reasonably careful CPA would use under similar circumstances.
Okay, so it's measured against their peers.
Exactly. And the elements to prove it are pretty much the same as general malpractice. You need duty, breach, causation, and damages. Now, a really interesting question that comes up is, to whom is the duty owed? For negligence, generally, the CPA's duty is to their client, obviously, but it often extends beyond that. It can include any person or limited foreseeable class of persons that the CPA knows will rely on their work.
Like a bank, maybe? If the CPA prepares statements for a loan application.
Perfect example. If the CPA knows a specific bank will use those financial statements to decide on a loan for the client, the CPA likely owes a duty of care to that bank too, even though the bank isn't paying the CPA's bill.
Hmm.
However, there's an important exception, or rather a different view in some places. It's called the minority view, often linked to a case called ultramares. Under ultramares, liability for negligence is much narrower. It's generally limited just to those in privity of contract, basically, the client and any third parties who are specifically intended to benefit from the work and named as such.
Whoa. Okay. So let me make sure I get this for everyone listening. In most places, if your CPA messes up negligently and someone they knew would rely on their work gets hurt financially, that CPA could be liable to them.
Generally, yes, that's the majority view.
But in these ultramares jurisdictions, it's much tougher. It's like, unless you were the client or explicitly named in the deal, you probably can't sue for just negligence.
That's a good summary. It significantly narrows who can sue for ordinary negligence, a much smaller circle.
Okay. Now, let's shift gears to fraud and constructive fraud. These definitely sound more serious than just carelessness.
They absolutely are. Let's tackle actual fraud first. This is intentional misrepresentation. It requires proving 5 specific things. 1, a misrepresentation of a material fact, something important. 2, intent to deceive. This is key. The person knew the statement was false. Scienter, they call it in law. 3, the plaintiff actually and justifiably relied on that false statement. 4, there was an intent to induce that reliance. They wanted the plaintiff to rely on the falsehood. And 5, naturally, damages result.
And the sources had that Mark Waters example, right? The CPA with Peach Tax Services.
Yes, a very clear illustration. Mark Waters, the CPA, owned the firm. For 3 years, he intentionally put false deductions on clients' returns. He then filed hundreds of these incorrect returns electronically, specifically aiming to generate fraudulent refunds. That wasn't a mistake or carelessness. That was a deliberate act with intent to deceive the IRS and benefit, presumably himself or his clients, improperly. Classic actual fraud.
Wow, okay, so that's actual intentional fraud. What about constructive fraud or gross negligence? How is that different?
Great question. Constructive fraud has the exact same elements as actual fraud: misrepresentation, reliance, intent to induce reliance, damages, except for one critical difference in the mental state. Instead of proving intent to deceive, knowing falsity, the plaintiff only needs to show the defendant acted recklessly.
Recklessly.
Meaning, they made the statement without knowing if it was true or false, basically showing a reckless disregard for the truth. It's not quite, I knew I was lying, like actual fraud. It's more like, I didn't bother to find out if this was true or false, even though I should have, and presented it as fact anyway. It's a very high degree of carelessness, bordering on intentional wrongdoing.
Okay, so it's worse than ordinary negligence, but maybe stops just short of proving outright intent to lie.
That's the idea. Gross negligence, essentially.
So, with fraud and constructive fraud being more serious, who can actually sue the CPA? Is it still limited like negligence sometimes is, or does the net get wider?
This is a huge point. The liability for fraud and constructive fraud is much, much broader than for negligence.
Mm,
A CPA can be held liable for fraud or constructive fraud to anyone who can prove those 5 elements we discussed.
anyone.
Pretty much. And here's the kicker. Privity is not a defense. That whole idea of needing a direct contractual link, it goes out the window for fraud and constructive fraud. Liability isn't limited to clients or third-party beneficiaries or even that limited class of foreseeable users we talked about with negligence. If you can prove the elements of fraud, you can potentially sue, regardless of your direct relationship with the CPA. It's a massive expansion of potential liability.
Wow. Okay, that really changes the game.
It absolutely does. And to kind of pull it all together, the research material helpfully summarizes these levels of care and the resulting liability and makes it pretty clear. Level 1, reasonable care is taken, also called due care. If the CPA does this, no negligence, no liability. That's the goal.
Right.
Level 2, there's a lack of reasonable care. This is ordinary negligence. Here, the CPA is liable to their client and that known or reasonably foreseeable group who relies on the work. Level 3, a lack of even slight care. This bumps it up to gross negligence, which is constructive fraud. Level 4, actual fraud. This requires proving that actual intent to deceive. And level 5, criminal fraud. This is the same basic conduct as actual civil fraud, intent to deceive. But now the government is pursuing it as a crime with potential jail time, not just monetary damages.
So levels 1 through 4 are civil between parties, but level 5 brings in the government.
Exactly. And the big takeaway from these levels: the more careless or the more intentional the misconduct, the The wider the net of who can sue and the fewer defenses like privity are available. It's a clear spectrum.
Okay, that spectrum makes a lot of sense. Now, let's talk consequences. If a tax preparer is found liable, negligence, fraud, whatever, what kind of damages can the client actually get? It's probably not just their prep fee back, right?
Oh, definitely not just the fee, usually. The damages can be made up of several different pieces. Let's start with the actual taxes. Generally, the tax money that the taxpayer should have paid anyway is not recoverable as damages.
Why is that? Seems counterintuitive.
Well, the logic is that the taxpayer ultimately owes that tax, regardless of the preparer's mistake. Paying the correct tax isn't in itself considered a damage. But there's a key exception. If the preparer's mistake caused the taxpayer to overpay their taxes, and they can't get that overpayment back, say, by filing an amended return, then that overpaid amount can be recovered.
Okay, so the underlying correct tax, no. But overpayments due to errors, potentially yes. What else?
Penalties. Courts very often award damages for penalties the IRS or state imposed because of the preparer's mistakes on the returns. That's a common one. Interest, too. If the taxpayer had to pay interest on underpayments caused by the error, they might be able to recover an amount equal to that interest, provided they can show actual damages related to it.
Makes sense. What about the cost of fixing the problem?
Absolutely. Costs incurred to correct tax returns are typically recoverable. This includes fees paid to another professional to file amended returns, or costs associated with fighting the penalties assessed. Basically, the cost of cleaning up the mess. And then there's a big category, consequential damages. This is really important.
What falls under that?
This covers indirect losses that happen because of the preparer's mistake. Think about things like lost investment opportunities or maybe lost income opportunities. If the mistake tied up funds or led to a bad financial situation that directly caused the taxpayer to miss out on a specific provable opportunity, those losses might be recoverable.
Wow, that could add up fast.
It certainly could. The idea is to make the injured party whole again, covering not just the direct hits like penalties, but also these ripple effect losses, these consequential damages. It really shows how serious the financial responsibility can be.
Definitely. Okay, shifting focus slightly. Beyond just liability for mistakes, the sources also talked about protecting information, privileged communications, and confidentiality. What exactly is an evidentiary privilege? Sounds very legal.
It is quite legal. An evidentiary privilege is basically a rule that protects certain confidential communications from being revealed in court. Think of classic examples like attorney-client or doctor-patient privilege. Information shared within those specific protected relationships generally cannot be forced out as evidence in a legal proceeding without the permission of the person holding the privilege, usually the client or patient.
Why have these privileges?
The main idea is to encourage open and honest communication. People need to feel safe talking to their lawyer or doctor without fearing that every word will end up in court.
Okay. So do CPAs get any similar privileges for the sensitive financial stuff they handle?
They potentially can, yes, in specific situations. There are a few relevant ones. First, the attorney-client privilege can sometimes extend to a CPA. This happens when an attorney hires the CPA specifically to help them provide legal services to the attorney's client. The CPA's financial expertise is needed for the legal advice. In that context, communications with the CPA might be covered.
So the CPA is working for the lawyer, essentially.
Kind of, yes, assisting the lawyer in their legal capacity. Then there's the work product privilege. This protects tangible materials like reports, analyses, spreadsheets that are created specifically in preparation for litigation and usually at the request of an attorney.
So the document itself is protected.
The document, yes. But it's important to note, this privilege usually protects the document, not necessarily the back and forth communication about the document between the lawyer and the accountant. Subtle difference there. And then, perhaps most directly relevant day-to-day for CPAs, there's the tax practitioner taxpayer privilege. This comes from the Internal Revenue Code, specifically Section 7525.
Okay, Section 7525, what does that cover?
It applies to tax advice given by a federally authorized tax practitioner. This includes CPAs, enrolled agents, enrolled actuaries. The advice is protected if that same advice would have been covered by the attorney-client privilege had it been between an attorney and a client.
So it tries to level the playing field somewhat between lawyers giving tax advice and CPAs giving tax advice.
That was largely the intent, yes, but there are some very important limitations.
Okay. Like what?
Crucially, this privilege only applies in non-criminal tax matters before the IRS and in non-criminal tax cases in federal court where the U.S. is a party.
Non-criminal only. That's a big one.
Huge. If it turns into a criminal tax investigation, poof, the privilege is generally gone. And another major carve-out. It does not apply to any written communication related to the promotion of tax shelters. Congress specifically excluded that.
Got it. So helpful in specific civil tax advice situations, but definitely not an absolute shield for everything.
Exactly. You have to know the boundaries. And remember, these are federal rules. State laws on accountant privilege can vary quite a bit.
Right. Always check state law, too. Okay, last big topic from the sources. Work papers. We hear this term all the time. Who actually owns them, and who gets to see them?
Yeah, work papers, the notes, schedules, analyses the accountant creates while doing the job. It's a common point of confusion. The basic rule is pretty clear. The work papers belong to the accountant or the accounting firm that created them. They do not belong to the client,
Really? Even though it's the client's information?
even though it's the client's information. The physical papers, the digital files that the accountant creates as part of their process, those are the accountant's property. However, and there's a big however, the information on those work papers is confidential. So the accountant is generally prohibited from showing the work papers to anyone else without the client's permission.
Okay, so accountant owns the paper, client owns the confidentiality.
That's a pretty good way to think about it. But, like the privileges, there are exceptions where the accountant can disclose work papers without client consent.
Ah, more exceptions. Let's hear them.
Okay, first, if they receive a valid subpoena in a court case, law trumps confidentiality there. Second, they can be shown to a prospective purchaser of the CPA's practice, but only if the purchaser agrees to keep the information confidential. They can look, but not spill the beans. Third, for a state CPA society, voluntary quality control review helps maintain professional standards. Fourth, and this is important, if the CPA needs them to defend themselves in a lawsuit brought by that client, you can't sue your accountant and then block them from using their own records to defend themselves.
Makes sense. Any others?
Yes. Fifth, similarly, in defense of an official investigation like from the AICPA or a state licensing board. And sixth, if GAAP generally accepted accounting principles actually requires disclosure of certain information in the financial statements, which might be derived from the work papers.
Okay, quite a few exceptions.
There are. And one key takeaway, a pass key mentioned in the source material, is about those prospective purchasers again. While a CPA might let a potential buyer review the work papers under a confidentiality agreement, they cannot just hand them over or transfer ownership of them to the buyer without getting the client's permission. Reviewing is okay. Transferring ownership needs client sign-off.
Got it. That really underscores the balance, doesn't it, between the accountant owning the physical work and the client's right to keep their information private.
It's a very delicate balance, absolutely. Professional ownership versus client confidentiality.
Wow, okay. We have covered a ton of ground today. What a deep dive, seriously. From breach of contract through the different levels of negligence and fraud, what damages can actually be claimed, and then into the weeds of privileged communications and who really gets to control those work papers. My head's spinning a little.
It's a lot, no question. But understanding these nuances, especially around who you owe a duty to for what kind of conduct or, when information really has to stay confidential, it's just fundamental.
Right.
For practitioners trying to do the right thing and manage risk, and for clients wanting to know their rights, it really highlights why clear engagement letters, ethical conduct, and just good communication are so incredibly important.
Absolutely. So for you listening, what does this all boil down to? Well, next time you're working with a tax professional, or maybe if you are that professional, just take a moment to think about all these layers of duty, responsibility, and confidentiality that are operating maybe quietly in the background. It's definitely not just crunching numbers. There's this whole legal framework supporting and sometimes complicating the relationship.
And then maybe a final thought to leave you with, something to mull over. We've talked about the rules, David. Tax law is always changing. Technology like AI is entering the field. Business is more global. Given all that, how do you think this landscape of legal liability for tax professionals might shift and evolve in the coming years? What new challenges or responsibilities might emerge?